Man, oh man, what a busy week for this guy. You guys have sent me so much material to take a look at, asking me to explore these different theses and hypotheses and cycles that people think may or may not be happening. And I've been spending dozens of hours consuming and trying to understand and synthesize the data set. So I was watching the video from Biggie Smalls from Reddit. I've been watching a bunch of different Richard Newton's video. I got one pulled up right now. And man, like, how fun is the puzzle? I'm having a blast. From somebody like me that's been in markets for so long, like I'm in my 17th year of trading. Finding really interesting things like this to try to dissect is very entertaining for me. It's just a cool thought exercise to run through. So what I'm working on now is actually a model that takes the different rule sets that they're outlining in terms of their assessment of when a cycle kicks off and some of the different things that might emerge over the course of a cycle, and seeing if we can project forward any of it. Because the guys are doing a great job specifically trying to stay as objective as possible. Nobody's like pontificating, this is what's happening. Most of them are saying things like, if this is the case, if this is true, which is massive. That's really important for you people that watch the videos, because what you don't need are people that are skewing the way you receive information. As you could tell, I'm very against that. I want you guys to be able to make your own inferences based on the data that we can find, and they're doing a great job at that. So I'm hopeful that maybe I can help pitch in a really small way, but I'm mostly learning from them in terms of these theories. They're incredible. Now, I'm not ready to dive into any of that yet. It's way too early. I need to collect a much larger data sample. I did a bunch of different Monte Carlo simulations to get an idea of what this could look like using some historic data to shape the model, but it's way too early. I don't want to throw noise out there when we're really trying to solve a puzzle. So until I have something a little more concrete, I'm going to continue sticking to what I know how to do, which is looking at options markets, looking at markets in general, and seeing what's going on. And today is the 23rd of June, and we are back at another interesting weekend. So what I'm doing now is comparing the options chain from 21 June to 23 June. And I'm looking at a few different things. I'm tracking this expansion of volatility for each expiration cycle across all of them, essentially going all the way out the full options chain. And I want to see what the variance or the delta in volatility is between the 21st and the 23rd. I want to see how they're calculating that on a vol per day remaining. And I'm kind of building this out in parallel, because one of my ideas is market makers are pretty smart. So if this is something that we on the retail side are starting to get a glimpse at, my hypothesis is the market makers already know all of this. I have to make that assumption because they get to see all this data. We're piecing it together from all these other pieces, and yet they already have the picture because they're pretty much the ones executing it, especially in Biggie Smalls' idea in terms of them internalizing orders. There's a lot of questions I have with that just in terms of the sourcing of the shares and stuff like that. But again, I'm not looking to add a bunch of conjecture out there. I'm just looking to understand right now, right? Just like our boy, what was it? 7 Habits of Highly Successful People. Seek first to understand, then to be understood. So I'm very much in that first phase, seeking to understand. Now, when I look across the options chains, the very first thing I'm noticing is that the absolute gross variance in volatility per day is essentially happening 19 July and in, because that takes us even to 20% or 0.2% vol variance on a per day basis going out 26 DTE. And then it really starts to drop off precipitously beyond that. So what that tells me is that we're still seeing relatively more action in these near term expirations, which is very common. That's nothing super novel with options in general. The front expirations derivatives really across the board, we'll see way more activity in the front expirations. They're going to be more liquid, more active, stuff like that. So nothing in here screaming at me as strange. What is strange to me, though, is looking at the variance in volatility between this coming week and the next week. This is very big. So the change that we've seen so far in volatility from the 21st to the 23rd for this 28 June expiration cycle is not insignificant. It's a 27.7 point variance in vol, which is 5.55% vol per day, as compared to everything else, which is sub 1%. So again, this goes back to kind of this standard game of hypothesizing what's going on. And one of the things I noticed right out of the gate, let's look at the out of the monies, is that we're seeing the same massive call implied volatility skew. So again, the reason why I put the cursor here is so that you can see where it caps out on the put side, which is right now like 487, 488, something like that. And on the call side, we have vols all the way out at the 128s. That's like 580. And again, we can confirm it by going out here. We could pop out to those 128s, take a look at the current vol, 580 right on the nose. So a few things going on here. The first one, there's a lot of activity in these really far out of the monies. And this is probably a lot of people throwing their money away, genuinely speaking. And I don't want to see that. And I say it that way because I made a video that I'll link in the description below for you to check out on how to buy call options specifically in things like GameStop smarter. Because what's happening is the market makers are juicing up these really far out of the money premiums. And again, this isn't necessarily to like screw it to the retail traders. It's because if they assess risk, that's where they're going to try and cover their risk. And what that means is, as they're trying to make a market way out here in the nosebleeds, they have to carry this crazy inventory that, again, for something like GameStop, there's always the puncher's chance that this thing just flies off the handle and you don't know when yet. Waiting to see how much headway we can make on these different cycle hypotheses. But right now, we really don't have a concrete understanding of when they kick off or not. And I actually, one of the reasons why I'm tracking volatility like this is I actually think we might be able to see the market makers pricing it in if they know it's going to happen before it happens. Now, it's kind of difficult because sometimes with these really far out of the money strikes, there will be kind of flash orders that get sent out there by the market makers. And that's because they don't want to expose their volatility calculations if there's no market being made right now. So essentially what that means is they'll rest orders at a vol that they don't actually think it is right now. But if people start coming in to kind of trade on the market, they would update their orders. And this is more of competition between market makers as compared to you versus them. But anyway, you should know that that's a thing as well. So when I am looking at this chain, I'm seeing a ton of really far out of the money options. Now, this becomes really, really important if GameStop starts rising like crazy. If GameStop starts flying up, this creates massive buying demand from market makers. Because here's the deal. Right now, even for these right here, for example, there's 14,600 volume at the 30s, it looks like. And they're only at 21 delta. So right now, the market makers aren't super incentivized to carry a full hedge. They probably maybe use synthetics. The way that they do their business is obviously discreet to them. I don't know, but we know kind of the general approaches that they will take. What we do know is that there's no incentive for them to have 100 shares in their account to cover this 21 delta position. We know that. The reason why it becomes really interesting if there's a big price increase is because as these get closer to at the money, the market makers need to accumulate more shares unless they can internalize the order, meaning provide from their own inventory. That creates buying pressure. The more that happens, the more that they have to hedge. This is exactly what a gamma squeeze is. That's the primary differentiator between a gamma squeeze and a short squeeze, is a gamma squeeze is driven by market maker activities. They're just trying to hedge their position to capture the bid-ask spread and go home with the money that they made on the spread. But in order to do that, they need to get rid of and scrub off the excess risk. Because the thing is, for options that are further in the money, especially, like 60 delta plus, they already have most of the position, if not all of it, hedged, especially as it gets closer to expiration. But for these out of the monies, they're not at that point because they're more likely than not going to expire out of the money. But if for whatever reason, there's a catalyst that starts driving price, then they're forced to start hedging these in a really short-term time frame. That is where things start to get very interesting. Does that mean that's going to happen this week? We have no idea yet. We literally have no idea yet. When I take a look at the price action overall in GameStop, take a look, let me get my head out of the way. Take a look at the volume. It's just become anemic. And the other thing I find interesting is the amount of sale volume that came in on the 21st. That also very interesting to me. There could be a theory that the market was trying to scrub the price below the 24 handle. Why would they want to do that? Because then the 24s then expire worthless. And that's close enough that that's not outside the realm of possibility. Now, especially with something that had really low relative volume, it was 28 million shares on the 21st. So going into this week, what I'm really wanting to keep a close eye on is how does the front vol play? I want to keep an eye on this smile because my expectation, if this week follows anything like last week, is the put side is going to start jacking up, which again, for options traders, that's a tradable event. You can trade the expansion and put side vol compared on a relative basis to the call side vol, or both of them in conjunction, which is probably even more likely the case in this scenario, because we saw both the put and call side vol for the far out of the monies jack up into the expiration this past week. The other thing I want to keep a really close eye on is the order flow. So I have a bunch of different alerts and scans set to track both large orders and total flow so that one, I can see if any anomalous purchasing starts occurring, or two, if there's any big pricing opportunities that emerge from what we're seeing so far, at least. That's what we got for today. If there's any questions or anything else that I should follow up with, let me know. I love seeing what you guys are sending me. So any of these different videos, posts, anything like that that you think is worth taking a look at, let me know. Because again, I've said it a million times, you guys know this stuff way better than I do. I am getting caught up. I know options really well. That's my space. But getting into all of the lore and the background behind this product and the history behind it is kind of what I am in the drinking from the fire hose phase, getting caught up as fast as I can. All right, you guys, be an outlier. Enjoy your weekend. See y'all later.